Welcome to the final unit of options trading with Josh Luberis. In this last unit, we will be discussing risk management and advanced option trading concepts. By the end of this unit, you will understand the risks involved in option trading and be able to implement risk management techniques, as well as understand advanced option trading concepts such as volatility, time decay, and advanced option strategies. First, let's start with risk management. One of the key concepts in option trading is understanding and managing risk. There are several risk management techniques that can be used to help manage risk, such as setting stop-loss orders, using option spreads, and hedging. Stop-loss orders are used to limit losses in case the market price of the underlying asset moves against the trader. Option spreads and hedging are used to mitigate risk by offsetting potential losses with potential gains. Another important concept in option trading is volatility. Volatility is a measure of how much the market price of the underlying asset is expected to fluctuate in the future. It is an important factor in determining the time value of an option. Higher volatility means that the option has a higher time value and is therefore more expensive. Time decay is another important concept in option trading. Time decay refers to the reduction in the value of an option as the expiration date approaches. The longer the time until expiration, the more time value an option has. Lastly, we will be discussing advanced option strategies. These strategies are more complex and are typically used by experienced traders. Some examples include straddle, strangle, collar, and calendar spread. Here is a brief overview of some of the advanced option strategies. A straddle is an option strategy where a trader buys a call option and a put option with the same strike price and expiration date. The trader is essentially betting that the market price of the underlying asset will move significantly in either direction, allowing them to make a profit from both the call and put options. The strategy is typically used when a trader expects a big move in the market price of the underlying asset but is unsure of the direction. A strangle is similar to a straddle, but the trader buys a call option with a higher strike price and a put option with a lower strike price. The trader is betting that the market price of the underlying asset will move significantly in either direction, but the strike prices are different from a straddle. The strategy is typically used when a trader expects a big move in the market price of the underlying asset, but is unsure of the direction and wants to limit the premium paid. A collar is an option strategy where a trader buys a put option to protect a long stock position and sells a call option at the same time. The strategy is typically used to protect against a decline in the market price of the underlying asset, while also earning income from the sale of the call option. A calendar spread is an option strategy where a trader buys a long-term option and sells a shorter-term option with the same strike price. The strategy is typically used when a trader expects the market price of the underlying asset to remain relatively stable in the short term, but expects it to move in the long term. It's important to note that these are advanced option strategies and are typically used by experienced traders who have a good understanding of the underlying mechanics of options and the market conditions. These strategies also involve significant risks, and traders should carefully consider the potential rewards and risks before executing any trades. That concludes our course on option trading. We hope that you have gained a good understanding of the basics of options, option mechanics, option strategies, and risk management. Remember that option trading can be a complex and risky endeavor, and it's important to continue learning and developing your skills in order to be successful.